Reading and understanding financial statements can be very challenging, especially if you're just starting out on your investing journey. In this 4-part video series, we're going to start off with a brief introduction, then we'll move on and have a look at the income statement, then followed by the balance sheet, finishing up with the cash flow statement. A lot of these key learnings from this video series will be taken from Warren Buffett and the interpretation of financial statements, written by Mary Buffett and David Clark. Let's kick things off with a brief introduction. In the mid-60s, a younger Warren Buffett began to re-examine his mentor Benjamin Graham's investment strategies. And in doing so, he made two stunning revelations about what kind of companies would make the best investments and the most money over the long run. As a direct result of these revelations, he altered the Graham-based value of investment strategy. The purpose of this video series is to explore Warren's two revelations. Number one, how do you identify an exceptional company with a durable competitive advantage? And number two, how do you value a company with a durable competitive advantage? To understand Warren's first great revelation, we need to understand the nature of Wall Street and its major players. In the early 1930s, an enterprising young analyst on Wall Street by the name of Benjamin Graham noticed that the vast majority of hotshot stock pickers at the time on Wall Street didn't care about the long-term economics of the business that they were buying and selling. All they cared about was whether the stock prices over the short run were going up or down. Old Benjamin Graham also noted through these hot stock pickers, while caught up in a speculative frenzy, would sometimes drive up the stock prices to ridiculous levels in relation to the long-term economic realities of the underlying business. He also realized that these same hotshots would sometimes send stocks prices spiraling to insane lows that ignored the business's long-term prospects. It was these insane lows that Graham saw a fantastic opportunity to make money. Graham reasoned that if he brought these oversold businesses at prices below the long-term intrinsic value, eventually the market would acknowledge its mistake and revalue them upward. Once they were revalued upward, he could sell them at a profit. This is the basis of what we know today as value investing. Benjamin Graham was the father of this.